The Federal Reserve, as expected, raised interest rates yesterday by a quarter of a point, resuming its tightening phase after taking a pause in June. Fed Chairman Jay Powell touted resilient spending and plans to keep up the effort to slow down the economy and tame inflation. Here's the chairman of the Fed yesterday.
We can afford to be a little patient as well as resolute as we let this unfold. We think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Joining me right now in an exclusive interview is the chairman and CEO of Bank of America, Brian Moynihan, with Reaction. Brian, it's great to see you.
It's good to see you again.
Thank you so much for being here. You're just off of a very strong quarter at B of A. I want to talk about that. But first, give us your reaction to the Fed's tightening phase.
Well, the Fed has to win the battle on inflation, and they started late in their own admission, and then now they've been at it, and it'll take holding rates here, and that's what's clear. So our base prediction is they will cause a slight recession the first part of next year, and then the first rate cut will come in the middle of next year. But the interesting that recession prediction keeps moving out, which means the power of the consumer, the power of the American economy, good businesses doing good things, people out spending, you walk down 6th Avenue, you get run over by the tourists in town, and that's keeping the economy going, which we might get very lucky here that we have a very soft landing.
Yeah, a soft landing, but still a recession at some point. Yep. But you're right, pushing out. I want to ask you about debt and, in particular, commercial real estate. Consumer debt up $148 billion in the first quarter, reaching over $17 trillion for the first time ever. And people are worried about the commercial real estate market. How worried are you that higher interest rates are going to expose properties with commercial mortgages, construction loans that are maturing 2023 to 2025 and cause and trigger us into that recession?
Well, for us, commercial real estate is less than 2% of our portfolio in the office space area. And so if you look at it, it's a stress test all the time. Every quarter we stress test it with the Fed, and it's in very good shape. The loan to value at origination was 50%, and now even for those things they have to reassess because they've been downgraded, it's say 80%. But more broadly stated, the simple fact is the dynamics of people working in offices had been changing for a long time, and the pandemic changed it even faster, right? So sort of the flexibility workspace and stuff, and that's creating vacancies, and that's going to be something that has to be dealt with. But it's already going through the system. I mean, in the first quarter, or in the second quarter, excuse me, we dealt with some properties, and we'll continue to deal with them.
We had a pretty good season of the bank earnings. Your company reporting $7 billion in earnings. Wow. That is a huge number, Brian. The Fed shows credit card debt hitting $993 billion as of July 5th. You talked about the consumer within your quarterly call. Tell us what drove that incredible quarter that you just reported. Assess the second quarter for us.
Well, we had revenue growth of 11%, kept the expenses below that, and had 500 or 600 basis points operating leverage. That's what we do. It's the 8th straight quarter of operating leverage. We had 20 in a row before the pandemic. And so, but here's what's going on. As we look at the consumers in July, they're spending about 5% more than they spent last year in July so far through the 24th. If you look at that 22 to 21, that was 9%. So the consumer spending slowing down, and it's more aligned with a lower growth, lower inflation economy. And so that's why you're seeing the indicia of inflation start to tip over. And effectively, the Fed's rate structure, the taking out the monetary accommodation, will be tougher this time because the amount of fiscal accommodation that went in, to offset the pandemic far exceeded the pandemic damage, honestly. And that's what the economy is seeing. So we think they're winning. But the consumer's strong. The credit statistics are still below they were in 19, which was, multi-decade lows for us in the industry. So the consumer's strong. But what does it come down to? They're employed. And that's the thing. When people are working, they can spend money, they can pay their debt, et cetera, and that's what's going on. Now, we got to be careful because we're going to see the change come in, and this is where the slowdown in the economy, and our view is it's a slight recession, but we know it will slow down.
Yeah, you have been able to deliver increased profitability steadily since you took over back in 2010. You're doing that through growth as well as a focus on expenses. You've closed branches, you've reset employment levels, taking numbers down, and you're using more technology. You talk a lot about Erica, the chatbot. Tell me about artificial intelligence and how you're using technology to continue to trigger growth.
Well, Erica is a voice activated, if you want, or you can type it in. Basically is a predictive language. It answers questions based on your question, based on our data and our information. And it's a very sophisticated system. It is not what ChatGPT, because it doesn't have all the internet information and all that stuff, but it's a very sophisticated system. We started on it 8 years ago. It now it's done 1.5 billion interactions, about 150, 160 million a quarter. And what's interesting about that is each one of those would have been a phone call or a visit to a branch or something else. So people can use it and they like it. The satisfaction of those customers is huge, 18, 20 million people using it. And so it's got high promise, but it has to be very controlled. And that's the trick with artificial intelligence, is can you make decisions based on how it works and things like that. And so if you listen to the experts, it's not quite there yet. It will get there over time. But right now we use it to assist things that we know we can control. The information in your account, the question you're going to ask, the response is pretty clear. We can have people check those answers all the time to make sure they're right. But it does help bring down the expenses. I'll give you a statistic I was looking at the other day. I think in 2008 or so, I think we had the same number of employees we have today.
Wow, 2008.
Yeah, and so think about that. And so it went up when we did the Merrill acquisition. It went up when all those acquisitions came in, and then we worked that all through. And that has a lot to do with just applying technology, not artificial intelligence, but all kinds of technology. The digital platform took off. The way we have more Zelle transactions than we have checks written by a lot now, and it will soon catch ATM distributions. And so if you think about that, that's people using Zelle to pay as opposed to writing a check, and that saves a lot of effort on the consumer's part. They like it because it's a lot simpler for them.
Well, I'm glad you mentioned this, because Zelle and your efforts so far, because now all of a sudden we're having this conversation about digital assets and about a changing digital asset ecosystem. Right. How do you look at that, think about that in terms of tokenization and how financial services will shift with these new ways in technology? So
I think you need to sort out sort of digital assets as an investment class, and I'll let other people talk about that. But in the way we work today, about 60% of our consumer payments are made digitally.
Right. So it's not, you're already doing it.
There's nothing new. And that doesn't include you taking out a physical credit card and putting in a machine, which is really a messaging system based on a piece of plastic. So, it's high. And on the commercial side, it's all digital. $3 trillion a day of wires and stuff all initiated digitally. So it's already here. Now, if you think about the idea of blockchain and information travel, cross-border, lots of information and payments together. Those are great things. We have 300+ patents. We get more all the time. We're still figuring out how to make it really work. It's out there working in places. We have partnerships with people. So I think this is still out there in front of us. But the real thing is we got to get payments quicker. Makes things simpler for people and all that. We don't need to keep adding different ways to do things, because they're pretty good things right now.
Let me ask you about regulation. We're going to finally get details on this Basel III endgame, related capital rule changes for the banks with at least $100 billion in assets. How does that impact you? What are you expecting in terms of regulatory changes with regard to capital?
Well, we don't know yet, and we'll find out when they come forward. But if you look at the overall picture, the key here is they're trying to harmonize regulation around the world. And Basel III endgame, so-called, is to do that. And as you look at those regulations and you think about how they work, the care that has to be taken is to make sure the playing field is level. So if you look at the transactions going on right now, you can see that if you look at the largest bank in Germany, France, and England, their RWA are half of RWA. They do the same things we do. And so we've got to be careful as we do this, and yet their capital ratios are higher. So we have to be careful as we do this to make sure we have a level playing field. That's the question on the table. Inside the U.S., we have lots of cap on our industry. The industry does a great job. They just showed it again as we came through the early part of this year. That job is terrific, and they have lots of capital, lots of liquidity. They've been regulated well. They've been run well. And as a person who's been a CEO of this company for 13.5 years and been in this industry for 30 years, the industry is well run. My peers do a great job across all industry sides. So I think they have to be careful as they put in these rules to not make the U.S. less competitive. Because we're not talking about the big 8 banks and everybody sort of talks about it. We're talking about the idea of a $30, $40 billion bank or $100 billion bank not being able to compete for a middle market loan because a bank with a supplier in Europe is getting, lending to a supplier in Europe is giving a lower cost of capital to that supplier so they can be more competitive to bid for car seats into the car manufacturing process. And so that's the care we got to take. But at the end of the day, our company's been around 240 years. Whatever set of rules, we'll figure out how to apply them and make it all work.
I think you make such important points, thoughtful comments about where capital should be. We had a conversation with the head of the Florida Bankers Association earlier, and he made the point that a large amount of the top banks in the world are Chinese. They're coming at you. They want the market share. Now, it depends on the law whether or not they're actually going to be able to operate the way you operate in America. But how do you think about that? And how do you think about handling geopolitical risk? Because we know that we've got all this aggression coming from communist China. Have you prioritized how you're going to deal with this in terms of a potential conflict with China?
We work on that all the time. I mean, we have a little bit of dress rehearsal on what happened with Russia, Ukraine, and how you had to change with sanctions changing. So we're always worried about that. Again, that's one of the great risks for American economy is will the Chinese-American relationship be constructive, or will it go in a different direction? And that's something we look at all the time. If you back up from it, your core point is the Chinese banks are big. It's a big economy. It's a growing economy. They're owned by the government. They're already big. They're already competing against us around the world. Let's not be,
that's right.
That
big
they are,
time.
and they work in this country. So the reality is that's where the level playing field question becomes important. So, at the end of the day, we have a great company. We'll beat anybody. We have talented people. They're terrific. They're going to win. But in the end of the day, it's better for this country if the rules are more consistent, because at the end of the day, the talent, ingenuity, and capabilities of our companies, with our banks helping them, can win in the world.
What can you tell me about the banking sector today? We had deals to talk about. Bank of California acquiring PacWest, JP Morgan to acquire $2 billion of mortgages in PacWest. Give us your sense of the stability of the overall banking sector. You've got small and big. We just saw those collapses, Silicon Valley Bank and Signature. What do you want to say about that? And also, what about this JP Morgan deal buying all of those mortgages from PacWest? How does that affect B of A?
Well, it doesn't really affect us. We got a $200 billion mortgage portfolio, and life goes on. But I think JP was helping them get the deal done, which is terrific. Look, in the end of the day, stepping back, American banks, we'll have all different flavors. We'll have small banks, we'll have large banks, and we'll have everything in between. But as a person who's been in this industry since we were really in a couple states to where we are today, having grown through that, the efficiency and effectiveness and what we can deliver for consumers, the kinds of products and services, the cyber defenses and all that require scale. And you can see that in how our cost of operations in our consumer business, our wealth management business, or our commercial banking are much different. So I think the reality is allowing banks to merge together will allow that to happen. It's no different than what happened in drugstores. It's no different what happened in McDonald's earnings in the hamburger industry, right? In the fast food industry. These consolidations are inevitable, but what happens is the consumers benefit by them. And so you can go anywhere in the country, and the ATMs are there now. The branches we've opened opening up in 9 more new markets. We'll cover 90% of the population, whatever it is, with the same consistent products and services that people can expect. That's an efficiency. Now, the community banks will also be there, and smaller banks will also be there. It's just a different business model, just like you have a local drugstore and a national drugstore chain going on in New York City here or anywhere else. And so I think you have to think about this as being a need to bring companies together so they can be more effective with their customers, deliver for their customers, but there will be different business models. Yeah. And we shouldn't stand in the way of what the natural market will let happen.
Yeah, it just seems like there's a different sentiment in Washington right now with regard to mergers. Real quick before you go, where is the growth next for B of A? You've, like I said, been able to deliver strong growth, consistent growth, while also focused on expenses. Investors want to know, where does the growth come from next? And is it technology? Consumers want to know, what are the cool things out there in terms of what they can do now with technology in their bank?
Well, I think the growth is always going to come from sort of the core sets of customers we have, continue to do a great job with them, and they do more, and they tell their friends to do more, and that's what's happening. So we did 1 million new net checking households a year for last year. If you think about that, that's a significant number of primary households. In the wealth management business, we have customer flows at record levels, in terms of new customers coming in, net new customers coming in. And in the commercial business, our treasury services. So, the idea is we're a big company, and so you got to make everything work a bit. The markets business had a great trading quarter, has had many great trading quarters, and Jimmy DeMar and the team have done it. So the idea is if there's some silver bullet, you'd say, oh, this will grow. But across $100 billion in revenue, everything has got to work, and that's what we do. So it's one more customer, one more great product that customer, keep working it right and let it move forward.
Well, congrats, Brian. What a big growth story B of A is. We appreciate your time this morning.
Thank you very much.
Thanks very much. Brian Moynihan, stay with us. We'll be right back.